three numbers before the open. 1.4 trillion won, roughly $1 billion US dollars, deployed by SK Hynix into Korea's bond markets in H1 2026. 35 billion US dollars in high-risk overseas alternatives flagged by S&P at Korean insurers, and 24.1 billion won for KakaoBank's entry into capital finance. It's Friday, June 26. Here's what today's story could mean for the Korean market.
Yeah, it's definitely a data-dense morning.
It really is. And these three numbers might seem totally unrelated, like chip makers, struggling insurers, and an ambitious digital bank, but they actually point to one massive shift right now: the hunt for capital efficiency in a high-yield world. I mean, look at this 1.4 trillion won deployment by SK Hynix. They bought into card bonds, capturing a yield spread above 4.2%.
Which is massive, right? Especially when you consider that normal bank deposit rates are just stuck in the high twos.
Exactly. And a detail that really caught my eye is that banks even issued 660 billion won. That's approximately 470 million US dollars, tailored specifically to SK Hynix's exact April 2029 maturity preference.
Yeah, the sheer market power they're wielding is incredible. Banks are practically, bending over backward to accommodate them.
It's like, imagine you walk into your favorite restaurant and the chef has created a secret, exclusive menu just for you because you're their biggest VIP. That is essentially what banks are doing for SK Hynix right now by tailoring these specific bonds to their exact maturity preferences. But I have to ask you, if smart money like SK Hynix is locking down safe domestic 4% yields, are these insurers holding risky overseas real estate trapped in a bad bet?
Oh, they absolutely are trapped. And the mechanics of why are just fascinating. Like, think back a few years. The post-pandemic low-rate era pushed those Korean insurers into overseas alternatives simply because they had to chase yield.
Right, they needed the returns.
Exactly. But today, Korea's 10-year government bond yield has hit 4.2%. That is up 130 basis points year on year.
Wow, so the domestic opportunity cost has completely flipped. Why hold risky foreign assets when you get competitive returns safely at home?
You hit the nail on the head. The underlying logic of holding those 35 billion US dollars in risky foreign assets completely breaks down. Now they're just stuck with mounting unrealized losses. And here is the real hidden danger: the detection lag problem.
Oh, because private real estate isn't priced like a public stock, right?
Precisely. Unlike public stocks, where you see the price drop immediately on a ticker, private overseas real estate valuations aren't updated daily. The losses are already there, but they take months to officially hit the insurer's balance sheets.
Man, okay, so you have SK Hynix playing it perfectly and insurers getting caught by the rate shift. Then you look at KakaoBank playing a totally different game. They just approved acquiring Maston Capital for 24.1 billion won, roughly 17 million US dollars.
Yeah, which is practically couch change for a major bank. But they aren't just parking cash, they're buying structural growth. It's a tiny price tag, but the mechanism is what matters. This low-price deal unlocks highly lucrative installment finance and leasing licenses.
How does that actually change their business model, though?
Well, traditional banks are heavily regulated on basic consumer loans. But with a capital finance license, KakaoBank can suddenly finance heavy machinery, corporate vehicle fleets, or, expensive medical equipment. They buy the asset, lease it out, and generate steady, high-margin revenue streams that completely bypass traditional lending limits.
Right, so every player here is scrambling to optimize where their money sits or what it can legally do. So if you're a listener tracking these moves, what does this all mean for the market?
Earlier, we flagged SK Hynix's 1.4 trillion won bond deployment for stock investors. This signals cash discipline at a scale that reinforces the premium valuation case heading into Q2 earnings. The S&P warning on 35 billion US dollars of Korean insurer overseas alternatives makes those stocks a watch item for re-rating pressure, particularly as domestic bond yields now offer competitive returns without the detection lag problem. KakaoBank's 24.1 billion won acquisition price is small on paper, but the new license could materially expand the bank's revenue model beyond traditional loans from 2027 onward.
Watch how these capital flows reshape the broader #KOTOS-PI index in the coming months. Are we witnessing a massive structural pivot back toward domestic safety? Please note, this observation is for educational purposes only and is not buy or sell advice.
Absolutely, always important to remember.
That's today's AI PRISM, Stock Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a Won Ifro award-winning series. We'll be back tomorrow.